For decades, we were told a simple story. Lower interest rates are good. Cheaper money means more growth. Borrowing fuels innovation, jobs, and prosperity. But what if that story was only half true? What if the very tool designed to prevent collapse slowly created one instead? Because at some point, cheap money stopped being a lifeline and became a trap. A trap so subtle that governments embraced it, corporations depended on it, and entire economies forgot how to survive without it. This is not a story about one country, one crisis, or one bad decision. This is the story of how cheap money quietly rewired the global financial system and why escaping it may be impossible. To understand how cheap money became dangerous, we have to rewind, not to a crash, but to a rescue. Every major financial disaster shares the same opening scene: panic. Banks stop lending, markets freeze, confidence collapses. And every time, central banks step in with the same promise: we'll make money cheaper. Interest rates are cut, credit flows again, the bleeding slows. At first, it looks like success. But buried inside this solution is a dangerous assumption: that economies can safely return to normal once the emergency passes. They didn't. Instead, cheap money became permanent, and permanence changed behavior. Not immediately, not obviously, but decisively. Interest rates exist for one reason: to price risk. When money is expensive, only strong ideas survive. When money is cheap, almost everything looks profitable. After World War II, interest rates were relatively high, inflation was controlled, and debt was treated cautiously. Borrowing was something you justified, not something you assumed. That changed in the late 20th century. By the 1980s and 1990s, economies became increasingly financialized. Credit expanded, asset markets grew, and central banks discovered a powerful lever. Interest rates could shape behavior faster than laws or taxes. Then came the early 2000s. After the dot-com crash, rates were cut aggressively to prevent recession. It worked, temporarily. But something new emerged. Instead of productive investment, cheap money flowed into assets: housing, stocks, complex financial products. Debt stopped being a tool, it became a strategy. And the system learned the wrong lesson. Cheap money doesn't destroy systems instantly. It rewards behavior that looks smart until it isn't. Corporations learned they could borrow instead of innovate. Governments learned they could spend without immediate pain. Investors learned they could chase returns without pricing risk properly. Low interest rates made debt feel harmless. Why pay down loans when borrowing costs almost nothing? Why accept low growth when leverage amplifies returns? Why save when assets keep rising? This created a self-reinforcing loop. Cheap money inflated asset prices. Rising asset prices justified more borrowing. More borrowing increased dependence on low rates. The system didn't collapse, it stabilized around fragility. The problem with cheap money is not that it causes crashes, it prevents healing. When bad investments fail, capital should be reallocated. But cheap money keeps failing systems alive. Zombie companies survive, unproductive debt rolls over, and risk accumulates instead of clearing. By the time cracks appear, the system is already addicted. Then something changes. Inflation rises. Confidence shifts, rates must increase, even slightly, and suddenly everything built on cheap money begins to shake. When rates rise, debt doesn't just get more expensive, it reprices reality. Highly leveraged companies see profits vanish. Governments face ballooning interest payments. Asset prices fall, collateral weakens, and lending tightens. What was manageable at 1% becomes fatal at 4%. The danger isn't the rate increase itself, it's the scale of dependency. Entire markets were never designed to survive normal pricing. And once confidence breaks, it doesn't return easily. Every time the system destabilizes, the response is predictable. Cut rates again, inject liquidity, delay the pain. But each rescue reduces future flexibility. Lower lows require even lower rates next time. Bigger interventions become necessary for smaller problems. Eventually, the system reaches a point where rates can't fall further. Debt can't grow safely, and inflation limits intervention. At that point, cheap money is no longer a tool, it's a cage. Look around today. Global debt is higher than ever. Asset valuations remain detached from fundamentals. Markets react violently to small rate changes. This isn't accidental. The patterns are repeating. Easy credit, asset inflation, risk mispricing, dependence, and instability. The only difference is scale. The system didn't escape cheap money, it normalized it. 3 clear takeaways. Takeaway number 1. Cheap money doesn't eliminate risk, it hides it. Takeaway number 2. Prolonged intervention changes behavior more than outcomes. Takeaway number 3. Systems built on permanent support cannot withstand normal conditions. The real danger isn't the next rate hike. It's the question no one wants to answer. What happens when the system can no longer survive without emergency conditions? Because history suggests this isn't how collapses begin, it's how they become inevitable. If understanding financial decisions matters to you, not headlines, not hype, but cause and consequence, then this channel is built for that purpose. Subscribe for more deep financial autopsies and ask yourself one question before the next crisis arrives. Is this system stable or just supported?